Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about STAG Industrial Inc. Annual Report. STAG Industrial Inc. is a leading real estate investment trust that specializes in acquiring, developing, owning, and operating industrial properties across the United States. The company's extensive portfolio comprises 597 buildings spread across 41 states, totaling approximately 117.6 million rentable square feet. The company's primary focus is on providing various businesses and services related to industrial properties. These include acquisition of existing industrial properties, development of new industrial projects, ownership and management of a large portfolio of industrial buildings, operation and maintenance of these properties, to ensure optimal performance by offering a comprehensive range of services. STAG Industrial, Inc. has established itself as a prominent player in the U.S. industrial real estate market. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to increase. The stock price of STAG Industrial, Inc. has increased slightly in the past year due to several factors. One possible reason is the company's strong financial performance. STAG Industrial, Inc. has consistently reported high occupancy rates and rental income growth, indicating a stable and growing revenue stream. This stability and growth can attract investors and drive up demand for the company's stock. Another factor that could contribute to the increase in stock price is the company's strategic expansion plans. STAG Industrial, Inc. has been actively acquiring new properties and expanding its portfolio, which can lead to increased earnings and cash flow. This expansion strategy can also demonstrate the company's ability to adapt to changing market conditions and capitalize on opportunities. Additionally, the overall performance of the real estate investment trust, REIT sector, may also be contributing to the increase in STAG Industrial, Inc.'s stock price. If the REIT sector as a whole is performing well, it can lead to increased investor interest and demand for individual stocks within the sector, including STAG Industrial, Inc. It's worth noting that these are general factors that could contribute to an increase in stock price, but without specific data or information about STAG Industrial, Inc.'s performance, it's difficult to pinpoint the exact cause of the increase. STAG Industrial, Inc. maintains a market capitalization of $7 billion, broadly in line with the industry peer group. STAG Industrial, Inc. trades at a higher price-to-earnings ratio of 29 times, and a lower price-to-book ratio of 2.03 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 48% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 4.17%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. Rental rates play a significant role, with fluctuations affecting the bottom line. Vacancy rates also impact revenue, as empty units mean lost income. Economic conditions, including recessions and trade policies, can significantly influence demand and prices. Interest rates and currencies can also have a ripple effect on revenue growth or decline. Tenant defaults, such as bankruptcies or insolvency, can lead to significant losses. Lease expirations and changes in rental income from properties held for sale are other key drivers. Additionally, the amortization of above and below market leases into rental income, as well as depreciation and amortization expenses related to in-place lease values and tenant relationships, also impact revenue. The net income of the company underwent significant changes between 2024 and 2025. Initially, it decreased by an unspecified amount from $193.3 million to $279.3 million, but then increased by approximately $32 million or 46% to $37.7 million for the year ended December 31, 2025. However, the net income for 2025 was also reported as $273.4 million, which is an increase from $189 million in 2024. The profit margins of the company also experienced changes during this period. The NOI to net income margin increased significantly from 109.2% in 2023 to 141.9% in 2025. This indicates a substantial improvement in the company's profitability. The increase in same-store, rental income, and lease income contributed to the growth in net income. The reasons for these changes can be attributed to various factors. The increase in net income was partly due to the rise in rental income from new leases and lease renewals, which offset the reduction of base rent. Additionally, the decrease in total other expense, resulting from an increase in gain on sales of rental property, net, also contributed to the growth in net income. However, the increase in interest expense due to the issuance of unsecured notes had a negative impact on the company's profitability. The company's financial performance indicates a steady improvement in its ability to generate cash from its core operations. The data shows that the net cash provided by operating activities has increased from $460,292 in 2024 to $463,388 in 2025. This increase suggests that the company is becoming more efficient in managing its day-to-day operations and generating cash flow. This positive trend in operating cash flow is a significant indicator of the company's financial health. It implies that the company has sufficient liquidity to meet its short-term obligations and invest in growth opportunities. The steady increase in net cash provided by operating activities also suggests that the company's management team is effectively implementing strategies to optimize cash generation. Overall, the data indicates that the company is generating positive operating cash flow, which is a key metric for evaluating a company's financial performance. This trend is likely to have a positive impact on the company's ability to invest in growth initiatives and maintain its competitive position in the market. The company's debt level and interest expenses have undergone significant changes over the past 2 years. One notable change is the increase in interest expense, which rose by 20% from $94,575 in 2023 to $113,169 in 2024, and then by another 17% to $132,160 in 2025. This increase can be attributed to several factors. The company's interest expenses have been affected by changes in its debt structure. For instance, the interest rate on unsecured term loan G was swapped to a fixed rate of 3.94%, while certain loans had their interest rate adjustments removed on September 15, 2025. Additionally, new senior unsecured notes were issued with fixed annual interest rates ranging from 5.5% to 5.99%. These changes have contributed to the increase in interest expenses. Furthermore, the company's variable rate debt has increased significantly, reaching $1.3 billion as of December 31, 2025. This increase in variable rate debt is likely to result in higher interest expenses in the future. The fair value of the interest rate swaps as of December 31, 2025 was reported at $13.53 million asset, indicating a potential increase in interest expenses. In conclusion, the company's debt level and interest expenses have undergone significant changes over the past 2 years, with increases in interest expense and variable rate debt contributing to these changes. Management's primary objective is to achieve sustainable long-term growth in distributable cash flow from operations. To accomplish this, the company aims to own and operate a balanced and diversified portfolio that meets market needs and adds value to acquired assets. The company has made significant strides in sustainability initiatives, publishing an annual sustainability report since 2021 and participating in the Global Real Estate Sustainability Benchmark. This commitment to sustainability is expected to contribute positively to the company's long-term growth prospects. Management believes that the company's diversified portfolio will continue to benefit from competitive rental rates and strong occupancy despite a volatile economic environment. Additionally, they expect an increase in revenue from relet space due to higher rental rates on new leases compared to existing leases expiring in 2026. The company is confident in its ability to meet future debt maturities and fund acquisitions through regular pursuit of new financing opportunities. Management also believes that the current balance sheet is adequately positioned despite possible volatility in credit markets, with effective management of interest rate exposure on floating rate debt. The company has made several acquisitions and divestitures as part of its business strategy. In terms of acquisitions, the company has purchased properties with known adverse environmental conditions, page 17, and those that may have material environmental liabilities or compliance concerns arise after acquisition, page 17. The company has also engaged in external growth through acquisition activity, page 34, acquired properties through purchase, page 37, and settled forward sale agreements, page 50. The specific acquisitions made by the company include settling -4,169,738 forward sale agreements on December 31, 2025, and December 31, 2024. However, it is worth noting that some pages do not mention any acquisitions or divestitures. In terms of divestitures, the company has sold properties with certain environmental conditions, page 17, where they agreed to remain responsible for remediating or monitoring these conditions. The company has also settled forward sale agreements on December 31, 2025, and December 31, 2024, which can be considered a form of divestiture. Overall, the company's acquisitions and divestitures have been focused on managing its environmental liabilities and compliance concerns, while also engaging in external growth through acquisition activity. The company has a history of paying dividends to its shareholders. This practice is outlined in the company's distribution policy, which takes into account various factors such as cash availability and operating results. However, it's worth noting that the company has also entered into forward sale agreements, which may result in dilution of earnings per share, return on equity, and dividends per share. In addition to paying dividends, the company has also been active in repurchasing and retiring restricted shares of common stock. This practice was observed in the years ended December 31, 2025, 2024, and 2023. While there is no clear indication of share buybacks in the summaries provided, it's possible that this activity may be referred to as a repurchase or retirement of shares. Supply chain disruptions loom on the horizon. The current economic landscape is fraught with potential risks to global supply and delivery chains. As highlighted in various reports, construction delays and cost overruns are already being experienced due to labor, materials, and supply chain issues. Furthermore, concerns about potential supply chain disruptions are mounting due to a combination of factors. Tighter credit conditions, weakening tenant cash flows, and rising vacancy rates all contribute to the likelihood of supply chain disruptions. Additionally, geopolitical tensions are exacerbating trends that positively impact U.S. industrial demand, but also pose a threat to global supply chains. These concerns underscore the need for businesses and policymakers to be vigilant in addressing these potential risks before they materialize into full-blown crises. That concludes the financial summary for STAG Industrial Inc. Feel free to comment below, and I will be happy to answer them when possible.